So thank you all for being here today. This is our 8th annual, right, Matthew? Our 8th annual
I believe it's been 8 years.
Yeah, it's been about that long. So, obviously we wanted to be in person, but that unfortunately didn't work out this year. But what we'll do is anyone who is on the call or on this Zoom call will get a copy of the presentation as well as this video on the back end. So we may not get it today, but we'll get it to you as soon as we possibly can. Also, what we'd like to do is we're going to turn your screens off just to save a little bit of bandwidth. And then if you have questions for Matthew, what we'd like you to do is put those into the chat. And then at the end, we'll go through and cycle through those. We have a couple people here in the office that are going to help us manage that. And I think that was it, right, Matthew?
I think so, yeah.
All right, I'm going to turn my video off, and I'm going to manage the incoming people coming in and let you take it over.
Well, thank you, Michael. And good morning, everyone. It is still morning with you, right? I was very lucky enough to be in Denver yesterday. Last couple of days, your weather, as always, is better than Seattle. So I want to take about a bit less than an hour of your time to give you my opinions, rather, what I see going on in the world in general, but obviously most importantly in what's going on in the housing market, because that hits us all a lot. So let's start up with, hopefully I can get you to share my screen. Somebody can let me know that you can see the screen right. That would be great. Can you see it? Yeah, all right, good to go. All right, so starting off big picture, it's important to look at what's going on nationally as much as anything else. So to kick off with what's happening in the US economy. Well, this first slide, for me, is the most remarkable. Probably have to explain it to you, though. What does that 5.3 mean? In reality, it's 5.3 million more job openings in the country than there are unemployed people. That is an extraordinary statistic, and made even more so. I'm sure you all heard this morning, the January job announcement. Over 500,000 jobs were created last month. That is quite remarkable. Huge number. And January is a bit of an interesting one because of seasonality, but I won't get into the weeds on that one. But the bottom line is we have a very tight labor market. Why is this? Well, it's very simple. COVID. In the early days of COVID, a lot of our more mature workers, they said, I'm done with it. I'm out. I'm retiring. And so they left the workforce. But at the same time, a lot of our younger workers had an early midlife crisis. They didn't know what they were going to do, and they also left the workforce. So we have a situation right now where companies are starved for talent. Now, what happens when the market is like this, when there's more job openings than people to come work? Well, wages go up. And have they been going up? Significantly. And here I broke it down into high, mid, and low-skilled jobs. And you see the lead here, and this is, by the way, this is back in December. This is December summers. We won't get January for a few more weeks. But what we found out is that a lot of people that got laid off in the early days of the pandemic were those face-to-face industries, leisure, hospitality, these kinds of industries. And now hotels, bars, restaurants are open again. You got to hire them back. You got to pay them. So we've seen massive wage escalation. But again, it's really across the board. Even those high-skilled people working in professional business services, these kinds of things, still a significant increase in how much money they were taking home. Now, do you think that this is inflationary? You'd be right. And this is the core CPI, it's core inflation. I mean, I like to look at core because it excludes food and energy, the most volatile sectors. But you can see here, we got north of 6% through the course of last year. It is still remarkably high. But my forecast as we move through 2023 is that inflation is going to slowly come down. And again, it's less goods inflation, it's more services. And services are people working, which is still remarkably high. It is going to come down, but here's the problem. The Federal Reserve. The Federal Reserve, they have what's called a dual mandate, full employment. Well, we're absolutely there. In fact, the unemployment rate in January was measured at 3.4%. We haven't seen that number since the 60s. So it's been a very long time. Got that covered, but the other part is stable inflation at around 2%. So Goods prices, obviously, we all know, been going up for lots of reasons, not just supply chain issues and things because of COVID. A lot of price gouging, quite frankly, coming out of a lot of our larger companies. But the point here is the Fed has to address it. Are they addressing it? Yes, they are. How can they? They raise interest rates. And this is the Fed funds rate. And it's the interest rate, the only one that they can directly control. And it's the overnight lending rate between banks. But it does have applications all the way along the yield curve, meaning that it will increase, it slows down the economy by, in essence, raising the interest rate on credit cards in a lot of respects. So you can see here, back coming out of the bursting of the housing bubble, very low, basically 0% on the Fed funds rate. The economy started getting a bit overheated in 2016. They started raising it. Then, of course, pandemic came along, crashed it back to 0. And they have raised it up to 4% already. Another meeting they'll have at the end of this month. They'll raise it again by another quarter point. I think they're going to win there. But the bottom line is we're probably going to get close to 5% when all is said and done. The Fed wants to slow the economy down, but at the same time, not slow it down so much that we enter a recession. But here's a problem. They're not very good at it. And because of that, the expectation by almost every economist out there is that we will see a modest recession, likely kicking in at the end, second half of this year. Now, I will tell you that this is certainly not guaranteed. I mean, the jobs number, that was extraordinary. It really counters the fact that we're starting to see some easing in the economy. But it also means that it's likely the Fed will keep on raising rates further than they should. And the problem is by doing that, they should have started raising interest rates more than a year ago. They didn't. So they always start too late and then they carry on raising them for too long, which means we'll see a modest contraction, likely, but it's not going to be 2007. It's not going to be 2000. It's going to be a lot like 1990. Very modest drop, couple of negative quarters, then picking back up again. We will lose some jobs. And by my forecast currently, actually, let me explain this to you just a bit. That 159 number you see here, well, that means we should have added an average of 159,000 jobs per month in the first quarter. Now, I did this modeling, of course, before today's job numbers came out. So probably going to have to play around with that a little bit. But if we do see a contraction and a economic slowdown and a recession, probably about 1 to 1.3 million jobs will be lost. But again, we'll start adding those jobs back again in early to middle part of 2024. Now, yes, it's never good to hear that jobs are being lost, but here's a more interesting thing. You see, the Fed wants to get the jobless rate to about 4.1, and we'll get there. But it will go further if we enter a recession. But because the labor market is so tight today, we'll peak at just over 5%. Quite frankly, really not that bad. Now, as usual, no two economists can agree on anything. And certainly the guarantee that we will have a recession, there's no guarantee, certainly. But everything is pointing in that direction, and very specifically the yield curve. Now, the yield curve is the interest rate over time. And basically, the further you go out along that into 10-year treasuries, 30-year bonds, you should get more interest, a higher interest rate, because you'll invest your money for longer. Well, right now, the interest rate on 2-year treasuries is about 70 basis points, 0.7% above the interest rate on 10-year treasuries. And that is always a classic sign of economic uncertainty and the likelihood of a recession. Because quite frankly, we've never had the yield curve invert without having one. So, but not guaranteed, but quite frankly, I would be very surprised if we skirt around it. Now, the Fed's willing to risk a recession to bring down inflation. That's what it has to do. The bad part, as I mentioned, actually, the good part is that demographics are challenging. The unemployment rate will rise, but again, not by that much, or at least not to that extent you'd expect to see of double-digit unemployment. But there is one more thing which is worthwhile touching on, and that is the debt ceiling. Now, we actually hit that ceiling shortly, very shortly. And the problem, this is not looking at future bills, but this looks back at government spending previously, historically. Now, we need to be able to pay our bills. And right now, Congress is saying, well, no, we've got to make some changes before we agree to do that. We've always raised the debt ceiling. We have to do it because if we don't, well, one, we should only be talking about this hypothetically. It should never, ever happen. If you do, it will be not just a bad recession, it'll be horrendous. I mean, lots of bad things will happen. Ultimately, I believe that they will raise the ceiling. Classically, for most politicians, what they'll end up doing is coming out the last possible minute and saying, oh, look at us, we do well. Well, quite frankly, they could raise the debt ceiling today, but they won't. But do keep an eye on it. It's something which economists are keeping very close tabs on, just to make sure that we do pay our bills as a nation. Okay, so that's national. What's happening in your local labor market? And here, I took the number of jobs that were lost because of the pandemic, and then the number that were recovered. Now, you can clearly see here at the top, I mentioned earlier on, those face-to-face industries, leisure and hospitality, by far the hardest hit. Over 82,000 jobs lost, but it's recovered almost 78,000 of them. And you can see here that there are several sectors that have seen not just a decent recovery, but a lot of jobs added. Look at professional and business services. Yes, as with most parts of the country, not that many people were laid off. Yes, everyone was working from home, but they were still working. But a significant growth there. Transportation, warehousing, utilities, again, did very, very well, mainly because of moving goods around after the pandemic, done very well. Wholesale trade has doubled. So you can see here in general, good to see construction and growth in that sector as well. That pretty much the recovery of sectors that you'd expect to see. Government always lag, understandable. Financial activities, well, we're still seeing a lot of layoffs in banks, mainly because of layoffs in the mortgage divisions, because of a lack of refinancing activity. But in general, looking pretty good. Unemployment, low. I mean, you peaked above 12%, admittedly, very briefly, early days of the pandemic, but it's come down. It's still a bit touch higher than we saw before the pandemic, but 3.5%, really not that bad at all. We saw a slight increase through the course of last summer, because you actually did start to see more people looking for jobs again, but it's come down a bit from there. I'd mentioned the country losing jobs if we have a recession, and I expect that we will. That is true. However, I don't expect that you will see jobs lost, but in aggregate rather, but you'll be growing, but only by about a bit more than 1%. So slower growth, certainly, than you've seen for probably the last decade, but it is still positive. So new jobs are going to be added. That's good. And it's something which I cannot say for markets, or for states rather. California will lose jobs, and there's several other ones that will as well. So you will still see employment grow, but at a very, very modest pace compared to the level you've become used to. Okay, so that's the economic part. What about the housing part? Well, this is when these speeches should be evening and not morning speeches, because then you could have a cocktail. But it's morning. This is water, believe me. We'll start out with mortgage rates, and it is remarkably important. And here's why. This is the average 30-year fixed rate going back to, well, a couple of years. And you can see here, 2021, early part of 2022, we were notching below 3% on a 30-year fixed rate mortgage. What was happening? It was the Fed. And the Fed, at the start of the pandemic, they wanted housing stability. They did that in two ways. One, mandating a moratoria on evictions. You couldn't kick renters out if they weren't paying their rent. But on the ownership side, we had forbearance, basically meaning that people could not pay their mortgages and they wouldn't be foreclosed on. But more importantly, the Fed went on a spending spree, and they were buying a lot of 10-year treasuries and mortgage-backed securities. Why are those important? Well, mortgage rates are based on the yield on 10-year treasuries. You take the yield on 10-year paper, add on 1.7%, and that's where mortgage rates should be. We have a disconnect right now, but I'll talk about that in a minute. Now, because they were willing to accept such low interest rates, they went in it to make money, they wanted stability, that led mortgage rates to plummet to a level which this country has never, ever seen before. Well, they were doing that, and then you can see here, right, January of last year, things started changing. What happened? The Fed and Jerome Powell coming out saying that we were going to withdraw their support, meaning they were going to stop buying 10-year paper and mortgage-backed securities. Now, how much have they purchased in those last couple of years? $2.7 trillion. 12 zeros, big number. And so because they withdrew their support, well, the market, well, they're not prepared to accept such a low interest rate, certainly when inflation was becoming significantly higher than we become used to. So we saw mortgage rates, in essence, double in a remarkably short period of time. Now, we did see a bit of easing that came in back in the summer months, but then we peaked out at over 7%. But you can see here on the right side, we have started to slowly trend down. I mean, down below 6.1 a weekly rate, which that number came out yesterday. And in fact, yesterday itself, I'm not sure if you follow me on Facebook, but I put a little note out there. We actually broke below 6% for one day yesterday because of the Fed's announcement of actually raising rates. That was a good thing, but here's the problem with it. It was short-lived day because the job numbers were so robust, massive jump drop rather in the price of bonds, which when the interest rate went up. And so we saw we got back above 6% very, very quickly. However, the most important thing I think for you to understand is that, are we going to see rates rise again? And the answer to that question is no. This is my forecast through the rest of this year for conventional 30-year mortgages. I think we peaked in the fourth quarter. I think we'll average 6.2 Q1, ending up this year, average for the quarter in the final quarter of 2023 at a bit under 5.5%. So it is better than it was. And that is a great thing. But the problem is a lot of people want us to go back to below 3% again. Not going to happen. That was artificial. That was fake. It should never have happened. It did because of the pandemic, but highly unlikely to ever see it again. Now, I can look at this, and maybe some of you out there have been in real estate long enough, will remember the days of 8, 10, maybe even you, maybe one or two, you might remember 18% mortgage rates back in the early 1980s. But it's not that. And I still think really around that 5.5, it's not a bad number in 2023. And most people would agree with me, apart from millennials. Why do I say that? Millennials have never seen a mortgage rate above 5% in their adult lives. So they think this is quite the ripoff. And they're really not used to seeing rates at this level. Ultimately, however, we will see them come down. I think that rates are going to decline modestly through this year. But this is just one economist's view. I could be wrong. I doubt it, but I could be wrong. Well, I actually have a chat, occasional actually Zoom happy hours from friends of mine who are the chief economists for Fannie Mae, Freddie Mac, mortgage bankers, Wells Fargo, and a few others. Dry group. We have too many doctorates between us. But anyway, we were last chatting a while ago about our views on mortgage rates. And this is the annual average that we all came up with. Now, you see me, I'm here at 6%. Freddie Mac tends to follow Fannie Mae, always have done. So that's 6.4, Fannie 6.3, Wells, hair over 6, National Association of Realtors, 5.7. Now, Michael at Mortgage Bankers, I'm not quite sure how he came up with 5.2. I can't quite understand the math, but that's the number he came up with. But more importantly, I think you need to understand is that no one is expecting rates to rise. They are going to pull back. And as they continue to do so, it's quite likely you're going to start seeing some more demand from buyers. I have to remember that the old adage, or it's become an old adage now, which is you marry the house and you hold hands with the mortgage rate. And that is true. So what people need to be aware of is that they should not miss out on the house of their dreams, just they're waiting for a lower mortgage rate. You can always refinance down the road. Don't lose it, because the biggest concern that I personally have is that we won't have enough supply of homes for sale to meet demand. Why do I say that? Really rather simple. I say because so about 25 million of us either purchased or refinanced our homes in the last couple of years at mortgage rates at 3 or below. What is the incentive for those people to sell at where mortgage rates are today, unless they're going to pay cash? There isn't any. People will still move, don't get me wrong. The 3 classic reasons: job change, death, and divorce. But we won't see the churn of inventory that you would normally expect to see. In fact, nationally, we just squeaked by 5 million transactions last year. My forecast for 2023 is about 4.8. So we're actually going to see a further drop in the number of homes sold across the country. And mainly that's going to be because of where mortgage rates are today. They're going to trend down. It's going to be a good thing. I think once we get closer to 5, then more demand will start to come out, quite likely. And it wouldn't surprise me if we break below 5, but if that happens, it won't be until sometime in 2024. That's a bit too far out even for my crystal ball to forecast, but it would not surprise me. We get into the high 4s and likely stabilize around there. All right, so that's mortgage rates. How about demographics? Well, your population has been growing, but really not by much the last couple of years. Fairly stoic, and it has got a bit of hair. Couple of issues with that is, one, the 2020 census. I don't trust it because of the pandemic. Census taken by people knocking on doors. They weren't doing that. They were making phone calls. So I think that census, which occurs, as you know, every decade, there'll always be an asterisk, I think, by it in terms of the quality of data within it. But even though you haven't been growing, yes, you've still been adding people, but this is interesting. That dark blue bar you see, that's natural growth, births minus deaths. But the light blue bar is in-migration, people coming to your MSA from somewhere else. And you'd expect that to be positive. That hasn't been. Now, what's been going on? We did see certainly a lot of people moving, remote working because of COVID. We saw people coming into a lot of markets, going out. We created what I call Zoom towns. Zoom towns being areas, Boise is an example, Austin, Texas, Salt Lake City, where people moved to because they could work their jobs, work permanently remotely. Now, haven't seen that growth, but 60% of the growth you've seen in the last decade has been, so over half, from people moving into your market and not organic growth. I think that's going to be the future as you go forward, because the fact millennials, fewer children or no children, and they are likely to not age, especially as the older population gets older and starts dying, like those are a lot of the baby boomers. So have seen growth, but again, it has been from immigration. You saw significant growth in that sector several years ago as you started to expand energy presence in your market in terms of businesses. So growth has been as robust, but still most of it has been coming from migration and not from natural causes. Okay, now, when I say metro area, I should explain. These are the counties which we can look at today. Obviously, it's 12, depending on how you calculate, 12 different counties in the greater Denver area. But we're going to concentrate on Adams, Arapahoe, Jefferson, and Douglas. But actually, we're going to look down as well into El Paso, into Colorado Springs a bit later on. That'll be separate to this. So with the Denver market, you might have heard, obviously, I'm sure you have, Case-Shiller, the Case-Shiller Index. I like it because it's a repeat sales index. It looks the sale of the same house over time, rather than just what's sold in any quarter or any month. Well, here, the light blue line you see here, the nominal index. But what I did with the index is I adjusted it for inflation. Now you can see here, very normally, if you were to take the peak before the bursting of the housing bubble to now, wow, 120% almost. Well, that's unsustainable, even though you can see certainly the drop we've seen in the last few months because of where mortgage rates were going. But when you look at it, and the reason why I've adjusted numbers for inflation is the value of a dollar, let's say back in 2010, was a lot higher than the value of a dollar today, as we are all aware. So when you adjust it for inflation, it looks a bit different. Yes, it has increased in the last 15 or so years, only by 50%. So that really is not that bad if you look at it on an annualized basis. So again, if you start looking at these things and say, are there concerns about another housing bubble forming? No, I just don't see that occurring, at least not now. So we're going to concentrate on existing single family homes. We all talk about new construction as well, obviously. But a lot of the worry that the market, and a lot of worry that has come from some brokers, mainly the general public, is the perception that the market has become flooded with housing. As we all know, the reason why we saw a systemic price drop back following the burst of the housing bubble was the wave of foreclosures, people walking away from their homes that were underwater. And in any situation, the only time when you see consistent price drops, we dropped down by a third over the course of several years, is that there's more supply than demand. Well, here's a different way of looking at it. Yes, you can see here, definitely more listings. We get that. However, you're only on the 10-year average, and look at that long-term average. By the way, it goes back to 2006. No, I mean, all we're doing right now is we're back at a level of inventory we saw less than a couple of years ago. But we have very short attention spans. We tend to forget very quickly what's going on and what normal looks like. And so we were abnormal through the course of the pandemic. We all know that. But then it has changed. So it has risen, but has it risen to a level that we should be overly concerned about? I don't think so. And we look at pricing, and this is good, average list and sale prices. So near here, you don't adjust sale prices, by the way, for seasonality, which you do. The previous chart I showed you with listings, they are adjusted. Otherwise, it would look like a sine curve, kind of like here. It doesn't apply so much when you look at median, which is actually a better way of looking at it. But massive spike in terms of list pricing. I mean, above 1.3 million single family homes, extraordinary, but a massive drop off. And because we saw that 22% decline, that led sale prices to drop as well, because there is a relationship between the two. But you can also see here on the list price, just some stability coming in. Now, again, you don't adjust it for seasonality, so too early to state. But am I expecting to see a continued price crash? No, but we had to get off that sugar high and that rush that we got because of the Fed and because of mortgage rates being below 3. Because of course now, even around 6, well, that decreases buying power significantly. And naturally, you're going to see an adjustment. So that looks at average list prices, average sale prices. On the median side, again, we can see a bit of a less drop down, which is understandable. But we saw a median drop, list prices drop by 12%. Therefore, and there's a closer relationship on median between list price and sale price. And that sent sale prices down by a bit north of 10%. So is this bad? No, again, median does tend to demonstrate things in a bit of a different way. But if you go back here to this drop we saw back in 1819 in list price, what was going on there? Well, then, if you remember, we actually saw mortgage rates jump by about 1.5 points, and that caused that drop as well. So we are seeing some adjustment in pricing because the market today is different, the market that we saw through the pandemic when money was in essence free or extremely cheap. But sales, yes, we did see a pullback over about 24%. Difference between 2021 2022, but still above that long-term average. Does this describe a market to you that is in collapse? I don't think so. And I think for a lot of it, certainly through the second half of last year, and will be through all of this year, and as I mentioned earlier on, we won't see sales grow only because you are going to be market starved. You're not going to see the inventory out there because people are not wishing not to lose the mortgage rate they've got. So again, it's slower than you've become used to, absolutely, but still, quite frankly, pretty darn close to the level of transactions you saw in 2015 through 2018. Bad things? No, I don't think so. But a lot of people are trying to take what happened in 2007, housing bubble bursting, and shoehorn it somehow into what is going on today. And you can't. And here's why you can't. A friend of mine, Ali Wolf, and Ali is a housing economist as well. She went on, I think it was CNBC several months ago, and said, we are in a housing recession. Well, actually, she was talking specifically about the new construction market, not the resale market, but that's by the by. But when you mention those two words, housing and recession, in one sentence, oh boy, everyone gets panic stricken. They immediately go back and remembering what it was like in post 2007. It's not a housing recession. The two periods are completely different from one another. Credit quality is so much higher, down payment, all manner of things are different. If you want me to talk more about that in the Q&A part, I'm happy to. But to demonstrate why I'm not worried, let me show you this chart. And this chart shows sale prices over time from 2012, and that trend line, the dotted line you see there, well, that is a trend line for pricing between 2012 and 2019. And you can see here, very, very close. I think if you're a mathematician, the R-squared value is like 96. So it was very, very accurate. Now, what happened here? Oh, that is when the Fed started stabilizing the market and mortgage rates plummeted and the market got ahead of itself. Now, what's it doing? It is, in essence, reverting back to that longer term, more sustainable trend. But that's okay, and it really is. We just got ahead of ourselves. Does it mean we're going to see prices plummet from this point on? No, I think for most markets, the worst of the pricing declines are, quite frankly, already behind us. Well, we'll get into more detail of that in a minute, but I expect us to get back to around that trend. Yes, we could drop modestly below it, possibly. Not worried though, because that will, I think, as we go forward, be at a pricing will be at a pace in terms of growth that is sustainable. It does meet demand. Also, more importantly, that does meet what's needed given expected income growth. Because ultimately, home prices cannot go up by more than incomes. It doesn't work that way. The only time it can is when mortgage rates drop further. And because we'll see some decline in them certainly next year or so, but we're not going to get, it's not going to get down to zero. So we are reverting. We are not entering any form of housing recession. On the new home market, let's look at permits. Yeah, I mean, certainly coming out of the 2007 recession, permits have grown. Last year was a solid year. This year, I'm still waiting on December numbers. They're notoriously late from the Census Bureau. So this data is through November. Okay, but we haven't been growing as much as you would like to see. Now, why is that? It's because for many parts of the country, it is just so expensive to build. And what a builder will need to sell that home for, to make a return, make a margin, they can't do it. Many parts of the country, land is remarkably expensive. Labor is expensive. We've got about, I think, 300,000 fewer people working in single family new construction today than we had in 2005. Yeah, 2005. So labor is very hard, and certainly shutting down the borders, immigration policy hasn't helped that at all. Everyone's getting the STEM subjects. No one wants to learn how to swing a hammer. And that makes pricing, construction, labor pricing very, very high. Material costs are still high. Yes, we still have some supply chain issues. I get that, but it's not just that. Copper, steel, aluminum, trade wars with China still going up. Lumber, well, Canadian softwood import tariff. We're putting a tax on imported lumber coming down from Canada. That's still in place. PVC pipe, which tracks oil prices, that's expensive as well. So all these things make it expensive. So right now, we're in a situation where builders are just taking a bit of a pause. Now, we have seen listings in your market, again, in the greater metro area. Yeah, they have gone up, but again, not by that much. But on the sales side, you averaged about 1,800. So you actually did sell more new single-family new homes last year than 2021. But that's because, in essence, the market shut down. So it's still doing well. You are still building. That is good. But the problem comes in respect of pricing. So you got the average sale price last year was 853,000. That's a lot of money. It really is. So you can see that parabolic jump starting really in 2020, but really in 2021 and to a lesser degree last year. You were down around the 600s. Now you're in the mid 850s and your price per square foot is going up. And this is fascinating because some builders are starting to build slightly bigger homes because of the work from home situation or requirement for a lot of buyers, which is far more than we've seen in time, but a massive jump in price per square foot. So that's the bigger area. I know you're far more interested in a bit more granularity. So let's run through these counties. Now, these charts I'm going to show you, I think I have 6 or 7 for each of the counties we're going to take a quick look at, are the same. You'll see a lot of similarities, but some differences there as well. The listing side, yes, has risen in Adams County, but again, perspective, still below where you were in 2019. Again, these are adjusted for seasonality. So you're above that long-term trend. So there's been more supply out there. Sales pull back a bit, certainly well above the average for those 3-year period, 2019 through 2021, but still occurring. But here you see that sale price and the adjustment there. We've seen a fairly significant drop after a raging jump we saw in the average, not so much in median, obviously. So pricing has corrected to a certain degree. But again, when you look at it on that trend line, again, that reversion, not recession, you're about on it. But I think there's a bit more still to give in Adams County. So what's my forecast? I think pricing down by about 1.5 this year. Quite frankly, it's negligible to say the least, especially considering what we saw, the 10% growth in 2020, 15% in 2021, 10 in 2022. Now, because of that rampant price growth that residents in Adams County saw, 50.7% of homeowners in Adams County with a mortgage have more than 50% equity. That's a huge figure. I mean, more than half of homeowners are sat on 50% equity. Am I worried that giving a few pennies back to the market this year? No, I'm quite frankly not. I would expect, let's see, a very, very modest decline, but it is quite likely also that it'll be split. We'll see some further price erosion in the spring months, likely, then stability, and then we'll see prices start to increase again in the fall of this year. But again, you have to look at housing as not being fungible, meaning it's not easily transferable. So you need to look at the annual average rather than just look at it on a month-by-month basis. On the new home side, yeah, I mean, more permits have been issued, certainly. But look at where you were back in the early 2000s, not enough. And because of that, you've got about 120,000 owner-occupied housing units in the county. My 5-year forecast looking forward, about 7.5% growth, means what? Oh, you've got to deliver almost 9,000 new housing units. They'll be occupied by owners, not renters, by owners. Well, go back the slide and you'll see that you're probably not putting enough permits to meet demand. That's going to be an issue. Now, ultimately, that means you are likely to see some further upward price pressure down the road on resale inventory, unless builders really start picking up a bit more steam. On to Arapahoe County. Again, similar, actually very similar to Adams. Obviously, they're next door to each other. Increase in terms of listings, sales pull back fairly significantly from over 5,000 units to a hair above 4,000 last year. But that pricing correction, median, it's always interesting, the median, the average. The average suggests, we've seen a bit of a bump back up in sale prices just for that last month or so. This is data through December. Haven't got January's numbers at hand yet. At least I hadn't. I think they came in today to me. So, but median has not seen that jump yet. But if you take that average and you say, yeah, you're bouncing around that trend line, back above it again. And I think actually we will likely, based upon my modeling, say that pricing for single family homes this year, sale prices, are actually going to be a little bit higher than we saw last year. Now, it's certainly giving back some of that amazing growth you saw. We look at those sevens, which we kind of saw that for a while, but that almost 19% price growth in 2021 was amazing. But at least right now, given expected demand and a lot of other things that go into my forecasts, does suggest you'll see a modest increase if you look at the average sale price this year versus the average sale price in 2022. Good thing. On the demand side, permits, yeah, there's going to be enough permits issued, and that's going to be good if this pace continues. Now, again, last year, still first 11 months not there and likely won't meet it. But if we keep up that average of around a bit more than 2,000 single family permits issued, but as long as that translates a permit into a house, doesn't always happen that way, it'll work out. 165,000 people own their homes there. 5.7% growth, demand for more than 9,000 units. So out of all the markets that we've gone through, so much all of them, close to Adams County, I think we'll see more stability actually in Arapahoe County. On to Denver. Very, very similar. Modestly above that average in terms of listings, but again, only back to where you were, likely just as the very start of the pandemic. Didn't meet the number of transactions in the county you'd expect to see. Not surprising, obviously there. Pricing correction you see here as well is occurring. So when we see this, with the average still shifting up, again, it does, all things considered, I do expect, even though you could say, well, we saw the same thing in Arapahoe County, that is likely not to be the case here because it is certainly a more expensive county in which to live. And therefore, because of it, I do expect to see a modest drop in values, again, annual average, but it will look similar to the other counties we've already talked about. And the ones actually we will be talking about, and that is probably a little bit more price erosion occurring next couple of months, then some stability, and then pricing starting to pick up again as we move through the summer. Permits, unimpressive. I mean, it really is. It's quite extraordinary. I'm quite sure what happened to you guys in 2004, but not seeing it because you've pulled back other than 2021. I mean, you might hit the long-term average maybe last year, but not enough to meet demand. You got 163 basically thousand owner-occupied units, 10% growth. I'm expecting to see. Got to build 16,000 units. Given where permits are, unless you see a massive increase in them shortly, not going to meet it, I'm afraid. But hopefully you can start encouraging some builders, but it's going to be pretty hard in that market to meet where the demand's going to come from. On to Douglas, below in terms of number of listings, also below in sales. Kind of got a bit ahead of itself, it appears to me, in 2020 and 2021. But again, it's also a function, as we talked earlier on about Denver County, about price. I mean, you're down now, but you were well above, you're about $940,000 on average in that one peak you see there, dropped down to 775. But you still see here, market hasn't yet reached balance and is still above that trend line. So I think we're probably going to see a bit more price erosion going forward. And ultimately, that means the prices are going to drop. 2.3% is my forecast. Again, it is something which owners are giving it a bit back. Is this any kind of panic in the marketplace? No, it's not. And quite frankly, for many of these situations, and they all do look very similar, it all comes back to what I call, and you might have heard me say it before, think of the 1 in 10 rule. And the 1 in 10 rule states that, let's say you own a home and you have a mortgage rate of 5%, hypothetically, and your payment is X. Okay. But if mortgage rates go to 6% and you want to keep that payment the same as you were before, well, you can borrow 10% less to keep that payment the same. And so as you start seeing those rates go up, well, then people's ability to borrow at a level that they feel comfortable with in order to buy that house, well, that's eroding. That has to pull back. So all we are really doing here, I mean, you've got in Douglas County, I think it's 53.3% of owners with a mortgage have got more than 50% equity. So again, it's more than half. It's really more than half, I think, in pretty much every county which we're looking at. And I'll check on that in a minute. So modest decline, not worried about it at all. Permits, yeah, it's doing okay. Got better last year, that's good. But because you are not a massive market, 103,000 owner-occupied housing units, 12% growth. Yeah, you're gonna have to see demand for 12,000 new single-family units. It's gonna be interesting to see. You've got to keep on going. Permits have to also translate into houses. Jefferson, penultimate one. We're getting close to the end. Hit your long-term average. Quite frankly, listings around where you were in 2019. Not a big number at all. Just by a hair missed the average number of transactions we've seen in the last decade. Pulling back, again, more of a supply side issue, I believe, than anything else. Pricing has pulled back. Again, still not cheap though. You're still up in the 6 to 7 range, depending on if you look at average or median, and still above that trend line. And here again, I do expect to see a modest drop. When I say modest, yeah, it's actually the worst one out of all the counties that I analyzed for you guys in terms of price drop. But I will tell you this market in Douglas County, 61.9% owners with a mortgage, more than 60% have got more than 50% equity, more than 60%. Bit of a give back, worried? Absolutely not. On the new construction side, permits, unimpressive. I mean, you've not been meeting that long-term average. My long-term average, by the way, goes back to 1990. Yeah, 1,400 on average, a bit more actually, 1,448. So well below that. 167,000, almost 168,000 owner-occupied units at 4.4% growth, 7,400 units of demand. Given the permits you're pulling, no, not enough, not enough, quite frankly, at all. And finally, in El Paso, because I was asked to talk about Colorado Springs, different market, obviously. yes, listings have risen about on the 10-year average, and at a level you haven't seen since 2016. This is interesting. So this is actually one of the larger markets tend to be less frenetic than smaller ones, which is just the nature of mathematics. But sales, again, above that 10-year average, about 11,500 transactions. You just missed it. Maybe there'll be some revisions in the data that I'll be looking at next day or so. That basically on that line. But pricing has come down, even though we know there's still a lot of demand. And it is an area certainly for recreational, all kinds of reasons why people do like it. But you are above that trend line. Now, theoretically, you could say, well, hang on, this means that pricing should drop. But because of affordability for the better part, I actually think it's going to be flat this year. There's a lot of reasons why people do like that marketplace. And because of that, yeah, even if you eke out half a point, can't really complain. But bottom line, I do expect that market to be flat in 2023. Then we'll probably start going up again at a reasonable pace thereafter. Permits, solid, and that's good. If trends continue, then you absolutely will see demand be met. Even if you're seeing 7.5% growth, what does that mean? New demand, just shy of 13,600 new units. So what do I think about this world? Well, I think ultimately that reversion should be the word of the year. It really should. I don't see any necessity for panic in any respect. I think that it is a fact that we've just got to give a little back because of the insanity that ensued through the pandemic, and certainly on a pricing standpoint, I also don't think listings are going to rise too significantly, and that's going to be a good thing. But do remember that if you're worried, don't be. Credit quality, the average FICO score on an approved conventional loan last month was 768. Down payments are higher. The zero down option stupidity has gone away. That's not coming back. So, but we have to, as a country, give it back. Now, nationally, my forecast is that the US in its totality will see prices down by about 1% this year. Now, Lawrence NAR, he actually thinks they'll be basically up by, I think, 0.4%. So no one is expecting a massive contraction. My friends at Goldman Sachs are saying, yeah, this is not a very different environment, but we need to give a bit back to return to that stable pace of price growth. And that, I think, is what we've got to do. But even if some markets will see a very slight drop, yes, the media does like to hear all about that, and that bad press sells, and I understand that. But as far as I'm concerned, it's a situation that it shouldn't worry us. If you are a listing broker, accurate pricing is going to be remarkably important, probably more important now than it has been for years, because home sellers are still going to be of the opinion that their home is worth 100 grand more than the guy next door. We know that. So get the pricing right. Transactions will still happen. There is no doubt about it, but it's still going to be tight. I think until we start getting closer to 5, that it's going to be a disincentive for people to sell if they don't have to. But that unto itself can actually be supportive of pricing, because it means you're not seeing an oversupply. And so with that, I'm going to hand it back to Michael. Hopefully you've got some value out of my comments this morning. If you've got some questions, bring them on.
Wow, fantastic. Thank you, Matthew. Boy, every year it just gets better and better and better. And I swear, I think you sound smarter because you're British.
I've lived here half my life. There's a reason why I keep the accent. Michael, I really
So for on the phone, if you have a question, you can put it in the chat, or you can feel free to unmute and turn your video on. And then also, we will send out, once we receive the slides, which may not be today, but by early next week.
No, it will be today. You'll get them today.
Okay, so we'll have the slides out as soon as we get them to everybody, and then that you guys can send those out to your Sphere or your Windermere agent that invited you. But Andrew, Matthew, I'll ask the first question.
Sure.
Would you anticipate us seeing more scenarios where a homeowner wants to move a property where they may want to carry the mortgage or carry the note for a short window of time versus, as the market continues to heal?
everyone is chasing yield, right? So, and this comes back to the question of inflation. Now, all of us have been in a situation for a number of years now where we're looking at whatever cash we have in the bank or credit union, making you a whopping 0.1%, and crying about it. Sure. But so people are trying to chase different avenues to try and figure out how they can find a return. Well, the thing is, we've now actually seen on savings account rates getting up into the 4s now. I mean, I've got one with Amex, which is around 4, and I think it's a couple of. So if somebody carry the note, I would think that there's not enough of an incentive, especially given the fact the rates are coming down, to do that. But if you are trying to get a buyer in there, what we have been seeing, I've spoken to a number of brokers about this, people buying down points for the buyer as an incentive for them to buy. So, and that's, I think, we'll likely see more of that than a situation of carrying the note, which was certainly very popular when mortgage rates were above 10%. But I just don't see the spread there being enough that a homeowner would wish to go through that scenario.
Okay, great. I appreciate it. Andrew Wolf has a question. I'm gonna have him step in.
Hey, Matthew,
bring the baby with you. Come on, man.
He asked me to ask this question though. So as we see some of these job numbers adjusting, obviously we've seen good recovery here, but there's also, like you were saying, anticipation of maybe a small recession coming up.
Yeah.
How do we feel like these numbers are going to impact the relocation market from a real estate perspective? We do have a healthy amount of that here in Colorado. So do you anticipate any impacts there? If so, what do you think they'll be?
Yeah, and that's a great question, Andrew. It really is. And so, yes, we have. And I would expect to see that. And actually, I gave a speech to the Relocation Council of Oregon, I think, a month or so ago. And a lot was being talked about that, mainly because of the contraction in employment, specifically in the tech industry. Because you're seeing, the Facebooks, the Amazons of this world. And now we know, be careful when you mention Amazon, because yes, they get rid of a lot of jobs, warehouse distribution, that's fine. They got a bit bloated, but AWS is still making money. And so there are concerns there that as these companies start to pull back or certainly slow down their hiring, because again, they're publicly traded, they're only as good as the last quarter, that could impact the relocation industry. And so, yeah, there is concern about it. I think that it's going to be very dependent on the depth of contraction in that sphere. We know numbers are being banded around, let's say by Microsoft, of 18,000 people, of Amazon of 20,000. They're not insignificant at all. So could there be some impact? Yeah. Do I think it's going to be a massive cut? I would be surprised, because even though we'll be shedding some jobs, I mentioned by my scenario 1.2 million, but a lot of those are going to be service sector jobs. And these are not going to be homeowners. They're certainly not going to be subject to people that relocation per se. But also, even if we do lose 1.2, well, there's still over 157 million of us working. So it's not that bad. But yeah, it would not surprise me to see some impacts flow through relocation purely based upon the tech sector's focus now on growing again, because right now they're being hit very, very hard.
Yeah, and then I guess as a follow-up on that, since there could be some more like service sector style jobs, primarily renters, like you were speaking about, we are seeing here in Colorado at least a small pullback in rent pricing.
That's a good thing.
Yeah, I agree. So do you expect that to continue a little bit?
So what we saw on rents, and thank you, Richard, there's two parts to the rental equation, one of which is apartments, traditional apartments. The other one is single family rentals. Let's break them down into two different components. The apartment side, obviously moratoria on evictions. You couldn't kick anyone out. So when that moratoria went away, we saw massive jump in rental rates. I mean, in double digits, 10, 12, up to 17% in some markets in California. Big jump. They have come back down significantly, and they're down into the mid-single digits last year. I wasn't surprised to see that, again, depending on market, come down further. And the reason why I say that, we're going to be bringing online about 440,000 new apartment units in America this year. Big number. Again, supply demand dynamics work. But on the positive side also is where markets have got pricing has gone already, even with maybe a modest pullback, we're creating almost forced renters, people that want to buy, but if they had pulled the trigger a couple of years ago, it would have been great. They'd have bought a home for 20% less than its cost now, and a mortgage rate half of what it is now. But they didn't, either because they were still trying to pay the rent or save up for the down payment or various other things. So yeah, I expect rents will rise, but certainly the pace of rental rate growth has slowed last year. It'll slow again this year. But again, I still think we're going to be in that 3 to 4% range. But again, it's very, very market dependent. On the single family rentals, we lost stock. What does that mean? We saw rental rates jump because, again, you could not kick people out. These tend to be more mom and pop investors. They're not the BlackRocks of this world. Those guys have moved out of Colorado, and they're in Georgia, Alabama, Tennessee, Arkansas, because prices have got to a point now where it doesn't make sense. The yield's not there to rent out that house, given what you had to pay for that house. So they're not there, but the mom and pops are. Now, again, because they weren't getting the rent, they still had the mortgage to pay. That's one thing. They could have got forbearance if they wanted to, but a lot of the tenants weren't paying the utilities. That's the kicker. And so in 2021, these people are saying, "Oh, heck with this! I'm gonna sell. The market's brilliant. As long as they didn't buy crypto, they're golden." But they literally kind of sold out of that market. So, as with anything else, lower supply of single family rentals, yet you still got demand that has pushed rental prices higher. And so I think you're probably going to see rental rate growth in single family rentals above that you'll see in apartments this year.
Interesting. Okay, well, does anyone else have any other questions here before we let Matthew go?
So Aaron's going to have one.
Oh, I think we have one over here.
Sure. Can't see around the corner.
Okay.
I know, right? I know.
Oh,
We're
you're
checking-
appearing and
we're checking
disappearing.
it.
Yeah. But yeah, so
That's it.
all right, going once, going twice. All right, hey Matthew, thank you very, very much for your time here. Really appreciate it. I think that's going to be it for us today. So we really appreciate your time.
Actually,
here.
there was if Lil Buddy is still around,
Oh, there he goes.
he did put something in there saying permits used to be 3 months of single family homes. Now it's taking over 12 months. How will that affect the market? Yeah. And that's a great question. I'm not sure if he's still around or not, but thank you for that.
I'm here.
Oh, yeah. Oh, cool. Thank you. Yeah, of course it does, because it's about predictability. I don't know. What do I call you? I don't call you Lil.
Nobody, it's Larry.
Larry. Okay. Right, Larry. So, Larry, the problem, that's a massive problem for builders. We know we have a backlog, and certainly states and federally trying to figure out how to address this. And why is it so important? Because it's an additional cost to the builder. He's still got carrying costs, even though he's going through a permit application fees, which can be stupid as well. So he's got money out. And all you're doing is you're pushing out that timeline even further. And that just increases the risk to the builder, on top of the fact that he's got that carry cost. So ultimately, if it's taking 12 months, what does that mean? Well, it's going to be risky, point one, but it means that the house sale price has got to be higher to cover those additional costs. And so we need, and in fact, we see it here in Washington State, we've got to figure out how to improve, streamline the permit process, to make it more predictable, to make it faster. And I think that is going to be a problem. We know it's a problem here. Clearly, it's a problem in your market as well. Hopefully, your elected officials are aware of it, and your local building associations are trying to lobby to have it addressed, because it is going to be important. But if the home ultimately is not built, then again, that does tend to put upward price pressure on existing inventory.
Thank you.
Sam, oh, sorry, I'm going through the questions now, but I'll stop it.
Go ahead.
Sam said, what's the average length of time between filing for a permit and completed construction? Well, that's a hard thing to say, depending if it's raw land or if it's a finished lot. But certainly a home per se can be built in 90 to 120 days. But if you look at the filing for the permit, and if Larry is correct, it's going to take you a year to get a permit, then you're talking, it could be from filing to completion, you're looking a year and a half. If that 12 months number that Larry mentioned is accurate. Let's just add those two numbers together. So we've seen builders build start to finish if a pad has already been poured and is cured in 90 days. That can be done. But you have some issues over there with snow as well.
Just a little. We have one of our agents, Aaron, who actually works in a couple of our Windermere markets that have a question on the second home market.
Oh, sure. Hello.
Hello.
How are
How
you?
are you?
I am well.
Great. So I am, as Michael just framed up, I'm licensed in 2 states, and I'm just curious, one's my primary market, one's more secondary homes. What do you forecast or see with the second home market?
Yeah. Second home market, as you know, went ballistic through COVID. And it did remarkably well for a couple of reasons. One of which was borrowing money was so cheap. But more importantly, people were looking at a second house as a permanent alternative to a hotel-based vacation. That was going to be it. And so we saw a lot of interest in some really interesting markets across the country and did very well. Now, today, a bit different to a degree. One, are we going back in hotels again? Yes, we are. Almost the same as we were, more close to pre-pandemic. But more importantly, the cost of borrowing is different. And also, you tend to find a lot of second home buyers buy when the economy is flourishing. We don't go out, for 98% of us, buying a home is the most expensive thing we will ever buy in our lifetimes. Now, if the market's going great, stock market's doing wonderfully, then yeah, you feel comfortable kind of spreading some of that cash around or borrowing, certainly when mortgage rates were as low as they are, or were rather. Now, certainly the market has not gone away, but it is unlikely to be as robust as we saw back then. But people will still buy second homes. I mean, they understand the fact of housing as a long-term investment is very, very viable. And as rates come down, which they will, it's a good place to put money if you've got it. So I expect the market's going to do okay. It's just not going to be as flourishing as you saw it back the last couple of years when it was absolute insanity. It really was. I mean, here in Washington State, for example, Pacific County is a tiny place in the middle of nowhere, but on the coast, where you tend to see next to no transactions, went loopy. Economic phrase for, I mean, literally, people were running down there to the beach because they wanted to buy a home on the beach. And pricing went mad because of it, because people coming in from very expensive markets, they were either taking money out of the home because they've seen prices go up so much to use for that house as well. So has that gone away? No, but I think ultimately you're going to see a softer market likely through the course of this year than you've become used to the last couple, but it's still not going to go away. People still want to have those vacation homes in select areas.
Great. Thank you so much. I have a follow-up question on
Sure.
that too, just regarding kind of the return to work or people getting called
Oh,
back.
yes. Right. Return to work, and
Sorry,
that, yes, thank you for mentioning it. It's something I should have brought up, so I'm glad you reminded me. We are going to see more of that occurring. And so what happened? A lot of our larger corporations really kind of kicked the can down the road for years in terms of coming up with cohesive policies for return to work. Why were they doing it? Well, can't really blame them totally. Also, they were going to come up with these announcements, and the Delta variant of COVID came along. And so they stopped. And they were going to make these announcements, and then the Omicron variant came along, so they stopped. But now, and it really started with Bob Iger, head of Disney, coming out 2 weeks ago, saying, staff, you will be in the office 4 days a week, end of story. And that literally is it. At Starbucks up here, they said the same thing now, minimum 3 days a week, but it has to be a Tuesday and a Wednesday. So as more of these larger companies start formulating, coming out with details of their plans, I think you can have some fence sitters who have been waiting for that, who are going to say, once they know, that will then decide, one, will they move, or two, how far will they move? But more importantly, what somebody is looking for in a house has changed. A dedicated workspace that's not the dining room table, remarkably more important now than it ever has been. And so for a lot of these folks, once they understand how often they have to be in the office, that will then put a ring basically around that office location as to how far out they can move if they're going to move. That's one thing. But more importantly, if they're looking at their home saying this just doesn't work, then I would suggest that home sellers who have a dedicated workspace, well, their home is going to be at a premium to a home down the street that doesn't. So I do expect that this year we will see a lot more people going back to their workplaces. However, are we ever going to go back to 5 days a week, back to the days of 2019? We will not, ever. I think that ship has sailed. It's never going to be that way again. So it'll be interesting to see how it all plays out. But I do expect companies will start saying it's going to be X, Y, or Z, that is going to drive demand without a doubt.
Awesome. Thank you so much.
You are welcome so much. It's so funny. Michael keeps on floating in and out. It's like a genie in the background there. You're muted. Unmute.
We've been
There you go.
monitoring our chat. It doesn't look like we have any more questions. Matthew, I got one question for you though, before you wrap up.
Shoot.
So what's your forecast prediction for the upcoming Super Bowl?
Oh God, Lord. Fly Eagles fly. No, I think it's going to be a great game, but I think Philadelphia. So, but you know what? It's American football. I mean, I'm English. American football is rugby with Kevlar. It's going to be a good game. I think you should never underestimate the fact that you got two very talented quarterbacks. I'll be watching, not for the halftime show, but
Exactly.
no, I would be. But at the same time, Kansas, or I mean, they're a pretty impressive team. So
Yes.
you know, but the bottom line is, I'm on the West Coast. As long as it wasn't going to be the 49ers, I don't care.
Yeah, there you go. I love it. Well, thank you so much, man. It's always a pleasure. And it was good seeing you this week when you were in Colorado. as
Thank you.
always.
Likewise.
And we'll definitely be in touch. And if there's nothing else, we'll go ahead and wrap it up and give you back the rest of your morning.
Thank you, my friends. Thank you all of you for being here. Take care. Anytime if you've got a question about anything that I can help you out with, you know how to find me. That's why I'm here. I've got 6,500 of you lot out there
Right.
in our network. So reach out. And if I don't know the answer, I'm pretty sure I can find somebody that can. So with that, stay
Awesome.
safe. I'll catch up with you soon.
Thanks,
Bye, guys.
Matthew. Bye-bye.
Thank you, Mr. Gardner. Take it easy.
You too, mate. Thank you.